Dear viewers, welcome to my channel. This is Mohammad Shodir Islam, and today I shall discuss details of rate of interest. In general sense, interest is the cost of borrowing, typically expressed as annual percentage of loan amount. Some people say interest is the rent or charge of using others' money. We get a concrete and concise definitions of interest in the website of Bank of England, and that is, interest is what you pay for borrowing and what banks pay you for saving with them. Interest rate is shown as percentage of amount borrowing and saving with them. So we can say that bank charges proportion of loan amount by lending to its customers or borrower, and this charge is called the interest. When this interest is expressed as percentage of the loan amount is called the interest rate. We should keep in mind that all bank charges related to the loan is not interest. For example, when bank gives sanctions or disburse loan to its customers, it applied various types of charges such as handling charge, documentation charge, visiting fee, valuation charge, mortgage charge, vetting charge, etc. Though these types of charges related to the loan, but this charge is not the interest. This charges is called the ancillary cost of loan, not interest. Interest rate does not include these ancillary service charges. But APR, annual percentage rate, included all ancillary charges to loan. For this reason, annual percentage rate is all-time higher than the interest rate. APR is only financial appraisal tool, it's not rate of interest. From the accounting point of view, there are two types of interest, that is interest revenue and interest expense. When any lender earns revenue by giving loan, this is called the interest revenue to them. Borrower pays interest for taking loan from others. This is called the interest expense. Interest is the principal source of revenue and expense to the bank. When bank earn interest by giving loan to its customers is called the interest income, and the bank pays interest to its depositors is called the interest expense. Difference between the interest revenue and interest expense and adjusting other ancillary service revenue and expense is the net profit or loss of any bank or financial institution. Total repayable amount on maturity of demand loan and installment have two parts, such as principal amount and interest expense. The portion of loan that has to pay by the borrower is called the principals, and rest of principals of the installment is called interest expense. Beginning period of loan, interest expense will be higher than the principal amount. With the passage of time, interest will be diminished and principal amount will be greater than the interest expense of the installment amount. Any bank or financial institutions fixing interest rate by considering cost of borrowing fund, operational cost, risk premium, and inflation. Difference between the interest on lending and interest of deposit is called the interest spread. Higher interest spread maximizes the profit of the bank's shareholder, but it is detrimental to the borrower and depositors. Sometimes a high spread of interest indicate the inefficiency of the management of the bank, and it may causes of taking high cost deposit, hiring unproductive labor, operational deficiency, etc. Bank rate has a great effect on interest rate. If central bank increases bank rate, bank or financial institutions will increase the interest rate because bank borrow money from central bank through the bank rate and lend money to its customers to earn profit. Dear viewers, no more today. If you think that this video is beneficial to you, please subscribe my channel to get more videos. Thank you for watching.